Hello. In this video, we'll be going through contingencies. What is a contingency, specifically a loss contingency? A loss contingency is an existing uncertain situation involving potential loss depending on a future event. So a loss contingency is the potential of having to record a loss depending on something that will happen in the future. And whether a contingency is accrued and reported, which means we record it as a liability, depends on a couple of things. First thing is it likely that the future event will actually occur? And number two, what can be determined about the amount? How much will that loss be? And so when you're looking at a loss contingency, and think of a loss contingency as an example would be a lawsuit. A company is being sued by another company, right? So they may lose and they may have to pay out a sum, but it's not known and you don't know the likelihood that the company will lose or win, right? So what US GAAP requires is that you have to look to see if the likelihood of the future event is going to be probable, reasonably possible, or remote. So if it's probable, you think the confirming event is likely to occur. So if it's a lawsuit, or let's just say a company is under audit, right, with the IRS, and the IRS is potentially going to file, a claim that the company owes $500 million in additional taxes. If it's probable that the company will have to pay those taxes or will lose a lawsuit, then you're confirming the event is likely to occur, okay? If the chance of the event of happening is slight. So there's a very slight chance that you'll lose that lawsuit. There's a very slight chance that the IRS will win their claim for $500 million. Then the likelihood of the future event is considered to be remote. Reasonably possible is somewhere in the middle. If the chance of the event, right, the lawsuit or the tax dispute, is more than remote, but less than likely or less than probable, then it's just reasonably possible. And depending on where these fall will be the start of determining how it's going to be reported in the financial statements. So then you have to look at the dollar amount. So here, this is for the events. You have to look here in this column, is the event probable? Is the event happening reasonably possible, or is it not likely to happen, so it's remote, right? So let's just think about lawsuit. Now, if the lawsuit is probable, right? And then here, these are the dollar amounts of the potential loss, the potential amount that the company would have to pay out. If the event is probable and the dollar amount is known, then the liability has to be recorded and a disclosure note describing what it's for. If the event is probable and the amount is reasonably estimable, right? Then again, the liability must be accrued and a disclosure note must explain what's happening. Now, if it's probable, it's probably going to happen, but not reasonably estimable. I'll just erase this a little bit. Then if you cannot estimate the amount, you can't actually record a liability, but you do have to disclose it in the notes. And this is where pretty much all lawsuits fall under, is not reasonably estimable, because lawsuits usually can vary at such a wide range that you can't actually accrue liability, but you can disclose a note about it. If an event, there's only a remote chance of, let's just say, the lawsuit winning, then you don't do anything. Nothing is done. No disclosure, no liability, nothing is done. If the event is reasonably possible, so it's more than a remote chance of it, you know, us winning, losing, but less than probable of us losing, then whether you know the potential amount or not, it's just a disclosure in the notes saying, hey, this might happen, but we're not sure it's going to happen, so we're going to let you know about it because it might come up in the future. When a contingency is probable and can be, and the amount is known or reasonably estimable, that's when the liability is accrued. And the way we do that accrual is we debit loss on the income statement for the amount and we credit the liability. Sometimes a loss contingency is resolved using a non-cash asset. So think of potentially if a company has a very large accounts receivable balance and the company that they're supposed to receive that money from goes bankrupt. And then so it seems like it's possible, probable that that we as the company will not be collecting that accounts receivable. So we're gonna debit the loss. We would debit bad debt expense, and we would credit the asset, right? Either accounts receivable or allowance for doubtful accounts, depending on how the accounting is done for that company. But it's not crediting a liability. You're going to credit the actual asset. Typically, when a company has a pending litigation or lawsuit, the accrual for a loss, meaning recording, when it says accrual, it means we've recorded a loss or liability, is pretty rare. That's because any outcome of litigation is usually highly uncertain, and so therefore the loss is not recorded until after the settlement. Imagine if companies did record a liability from an ongoing litigation, but the litigation is still ongoing, then the plaintiff would look at the company's financial statement and use it as ammunition against the company, right? Because they're like, oh, they're kind of admitting that they did something wrong because they are accruing a liability for it. So typically companies do not accrue any sort of pending litigation. But they do should provide disclosures, right? If the event is, if it's reasonably possible that they will not win that litigation. If it's probable or reasonably possible, they should disclose it. And here's an example of, this is actually JP Morgan, but they just say the firm. And it says, as of December 31, 2022, the firm and its subsidiaries are defendants in numerous legal proceedings, including private civil litigations, government investigations, and so on and so forth. And it says, the firm believes the estimate of the aggregate range of reasonably possible losses, so it says it's reasonably possible, which means they do not have to accrue liability on the balance sheet, but they only have to disclose in the notes. So they believe that the aggregate range is will be anywhere from $0 to $1.2 billion. So that's a pretty wide range. Concept check. GK Inc. has the following outstanding litigation claims against it. The question is, GK should accrue a contingent liability of. So when we say accrue, it means that they should actually record a liability. We know that you only record a liability if we think the event is probable. So this third bullet point says a claim of $10,000, GK thinks it's reasonably possible it will lose. Well, if it's reasonably possible, it's just disclosed in the notes. So we are not going to accrue that. Now, a claim of this bullet point, the first one, a claim of $100,000, GK thinks it is probable that it will lose the claim and estimates loss of $75,000. Okay, well, that seems like we should accrue that for $75,000. The second bullet point says a claim of $50,000. GK thinks it is probable it will lose the claim, okay, but it cannot estimate the amount of the loss. Well, if they can't estimate the amount of loss, then they can't accrue anything. So the amount based on these 3 bullet points, the amount that they should actually accrue for is just the $75,000. What happens if you have a potential loss contingency right here? Some event occurs before the fiscal year end, and I'm going to say the fiscal year end is 12/31 just because I think it's the easiest. So we have a tax dispute, right, with the IRS right here that may, that we think is probable, but we can't estimate the amount, right? So we say, okay, well, let's just, in that case, we would just disclose in the notes. Now, at year end, we say at 12/31, we're like, okay, we're going to just disclose in the note because it's probable, but we can't estimate how much we're going to have to pay to the IRS for this tax dispute. Our financial statements, so our year end is 12/31, but the financial statements will likely only be made public, right, published on, let's call it February 15th, because it takes a while to close the books and then have the auditors go through them. So the financial statements are not issued until February 15th. What happens if on January 30th, we ultimately settle with the IRS and we say, okay, IRS, we're going to pay you $200 million. What that means is that between our year end, sometime between our year end and our financial statement, a subsequent event occurred that can clarify a claim that existed before our year end. So in this situation, if we settle with the IRS on January 30th for $200 million, even though that happened after our 12/31 year end, it happened before our financial statements are issued, we would have to accrue a liability as of 12/31 for the $200 million. It's important to note, though, that so here again, I have a 12/31 year end and my financial statements are issued on 2/15. What if a lawsuit comes about? Let's just say it's a lawsuit comes about on January 30th, or the IRS opens an audit on us on January 30th. In that situation, no liability would be accrued as of 12/31, but even though this came into existence, this potential liability came into existence after our fiscal year end, because we haven't issued the financial statements yet, we would provide a description of what's going on in the notes to the financials as of 12/31. Sometimes companies have unasserted claims and assessments, meaning a claim has yet to be filed, but if the company believes that it's probable, so just probable, that the claim will be filed, then it has to go through the steps to see if it should record a loss contingency as if it has been filed and it's probable. So in that situation, even though a claim hasn't been filed, if a company knows that a lawsuit is going to come about, and it's probable that it's going to come about, then they have to decide, do we know how much that loss could be? Is it reasonably estimated or not reasonably, or we can't estimate at all? Here's an example of a note in the financial statements. It says, various claims and lawsuits are pending against us in some of our subsidiaries. We cannot fully determine the effect of all asserted and unasserted claims on our consolidated results of operations. We have recorded a liability where asserted and unasserted claims are considered probable and they can be reasonably estimated. So in this situation, even though some claims have not been yet filed, they're still recording the liability because it's probable and they can reasonably estimate how much it's going to be. Last slide in this video is regarding gain contingencies. We've been talking about loss contingencies, right? When a company has to record a loss in the liability. Now, flip that to the other side. What if our company is the plaintiff in a lawsuit, right? And we are the ones that are suing another company for money. And it is, so we have potentially money coming in, potential gain contingency. No matter how much we think the likelihood of the event will occur, even if it's probable, we think it's probable that we are going to win and we are going to win, money and get money, $100 million, let's just say, gain contingencies are not accrued. We would not record a receivable for it and therefore record revenue or income for it. And that's because of conservatism. In accounting and US GAAP, we have to be conservative. And so we do record uncertain losses, but uncertain gains just are not recorded at all, even if they are probable. And if a gain looks to be material, meaning it could potentially affect a decision made by the user of the financial statement, then that potential gain can be disclosed in the notes to the should be disclosed in the notes to the financial statements.